David, hey, it's great to be sitting with you here in Bellevue, Washington. Appreciate you taking some time.
Thanks, Ed.
So let's talk a little bit about just introducing Evergreen Gavekal first. And so if you could just tell me about your firm.
Sure.
And what you tell clients when they first come in the door.
The firm started about 30 years ago. I started in the business 35 years ago, so I had a career pre-Evergreen. Actually, I didn't buy Evergreen until about 12 years ago. And then approximately 3 years ago, we did our quasi-merger with Gavekal out of Hong Kong, one of the finest macroeconomic research firms on the planet, somebody that your good friend John Malden holds in high regard.
Absolutely.
So that we felt that added a lot of depth to our firm in terms of their tremendous scope of research and also their Asian and European, but especially Asian orientation, which is an area that we obviously felt like we didn't have a lot of bandwidth in previously.
Okay.
So we do feel like it's made us a stronger firm. Kind of ironically, U.S. investors who were so interested in Asia a few years ago have lost their interest, at least temporarily, for reasons that you and I both know in terms of the U.S. stock market going ballistic here recently, right. Which we believe, and I think you believe, is very Fed-driven. But that will change, and investors will once again care about Asia, and so we think that connection is very important. I think another thing that is important to bring up about Evergreen, which I once again believe is a subject near and dear to your heart, is the issue of bubbles. And we've had a central bank in this country who, until very recently, has basically not believed that there is such a thing as bubbles, or if there are, that no rational central banker can recognize them. And we believe the Fed over the years has worn bubble blinders. And then their approach is that once they burst, go in and try to clean up the mess by creating a lot of cheap money, which unfortunately then leads to the next bubble, which they don't recognize until after it blows up, and it creates this boom-bust cycle that we've seen. So we think that one of our most important competitive advantages is the ability to recognize bubbles, which we've done as far back as the late 1980s with Japan. Now, it's always hazardous to try to go out on a limb and say, I think this is a bubble, because inevitably you're going to be early, and we certainly have been early in our bubble prognostications, but we've been right, and we view that as one of the most important things we can do to protect client assets. And we think right now is another example of a Fed, in this case specifically Fed-driven bubble, not just Fed-enabled. This isn't an error of omission, this is an error of commission by the Fed. And I almost gagged when I watched that little clip out of the good movie, very good movie, Money for Nothing, where Janet Yellen basically admonishes who's ever interviewing her that the country needs to move away from relying on bubbles to drive the economy when the Fed has created this most recent one. So it's sad, and what's really sad is that investors seem to keep falling for this pattern of the boom bust. And so we do believe there's another day of reckoning coming here with what's been created recently.
Well, and better to be early in calling a bubble. I think a lot of investors towards the end of a bubble cycle and a market cycle sort of forget the rule number one of investing is don't lose money.
And rule number two is don't forget rule number one.
Right, right. So
no, it's so true. It's John Hussman says it, I think, very aptly. You're either going to look like an idiot at the end of the bubble or after the bubble bursts, and our preference is to look like one before.
Sure.
Because the more, even if it goes way up, as was happened with the Japanese stock market in the late 80s, and then with the tech market, the OTC market in the late 90s, is that even if they go up another 100%, when the bubble pops, they come down so quickly, you're going to get another shot. And I think that pattern is unfortunately repeating itself in certain areas of the market today.
What is really concerning to me is seeing, particularly in the last 6 months or so, the number of retail investors coming back into their online brokerage accounts in numbers that we haven't seen since 2007.
So true. That's so true.
Give me an idea of the size of Evergreen assets under management.
We're about 1.2 billion right now, so we're reasonable size. We're not as big, obviously, as we're a rounding error, frankly, compared to a Fidelity,
Sure.
or a Vanguard. But for a regional firm, we're actually, there's very few independent registered investment advisors that ever break above the $1 billion threshold. So that is kind of a key level.
So, and that's an important term, independent. Can you talk to why Evergreen versus, I won't name names, but a large national shop?
Sure. The big brokers, for one thing, vehemently resist the notion of being considered fiduciaries. And that's because they really view themselves as marketing entities. And don't get me wrong, there's some very good people that work on what we call the sell side,
right,
the dark side. But the firms themselves, especially, I mean, just look at all the litigation they've been subject to over the years, and particularly post the financial crisis. You know, they've gotten so risk averse that if you're working within that environment, your latitude is so limited. And for example, the newsletter that we put out, the Evergreen Virtual Advisor, our free e-letter weekly, I could never
read it every
publish
week,
it.
by the way.
Well, thank you. You're one of the few. There's 10 or 12 others. But I could never publish that if I was within the confines of a major wirehouse.
Right.
I mean, the attorneys would wipe out, edit out almost every other word.
Sure.
So that's the kind of, and also I think what it leads to is kind of this group think, where everybody kind of says the same thing on, well, you've lost some of those guys in the past and gals that were really kind of maverick thinkers about the market. So for example, if you look at the major firms today and what they're forecasting for the stock market, every single one of them is predicting an up market.
Sure.
Every single one of them is also bearish on bonds. It's really pretty comical. But it did, you know, and oftentimes they're right for a long time, but this group think gets really dangerous because it tends to take whatever trend and really drive it to even a greater extreme. And then you see the, you know, of course, what happens after that is that the more it goes up, the more it's going to go down.
So, and there's really very little difference between all of them. So you're hearing the same noise from
very true.
all the big shops.
I think it's become very homogenized and very sanitized. And again, it's just all this kind of this mindset of being very risk averse. You know, there's safety in numbers, at least until the bubble bursts.
Sure. So what about Gavekal? How does having an internal research shop like Gavekal, which I would say is one of the best in the world, truly in the world, because they're
no
global,
argument for me.
How does that inform your investment decisions?
Well, you know, they're a fascinating firm because there's tremendous differences of opinion. So they're the opposite of what I'd say the kind of the big brokerage approach, where it's kind of homogenized and, you know, it's all airbrushed and so forth, because they have tremendous opinion exchanges internally, and they publish those because they're a part of the Gavekal team are what I would call some arch Keynesians. And then you have Louis and Charles, and I put myself in it. They're more of the Austrian school.
Okay.
And so, but it creates a lot of energy. I mean, it's good, I think, to have that kind of difference of opinion, that
sure,
clarity.
It's healthy debate.
It is, and I think clients like that. They like to hear both sides of the story and kind of let them make their decision, you know, based on hearing the two viewpoints of Gavekal. So I think that's a big deal for us, is to be able to access that. We see their internal emails, which are fascinating. So we just feel very fortunate.
So where do you think we're at in the investment cycle right now?
Very late stage U.S., but you know the world is not as coordinated as we might have thought. You know, this whole idea of you know of the decoupling that was so popular a few years ago has happened, but it's happened in a way I think is 180 from what the consensus viewed. In other words, you know, if you went back 3 years ago, you would have thought that if the decoupling was good, it would have been good for emerging markets and bad for the developed world, which was supposed to have sclerosis and too much debt and bad demographics and on and on and on. And of course, what's happened is from that very consensus view of 3 years ago, we've had a completely opposite outcome. And now, I'd say today, the risk is that there's too much confidence in the developed markets, the US being the #1 offender in that regard,
okay, and
too little confidence in things like the emerging markets, where we really are seeing some pretty compelling opportunities.
That's interesting, because if you only follow mainstream media, you're scared of emerging markets right now, given what's in the press.
And I think that's incredibly bullish when you see that kind of negativity, and especially when it's been happening for a while. And what we also, I mentioned this earlier, what we really look at are fund flows, and the fund flows out of emerging markets have been shockingly high. Actually greater than they were even during the 08-09 crisis.
Interesting.
In fact, there was as much money pulled out of the emerging markets in just the first part of 2014 than all of last year, which was a very negative year for emerging markets. We also think emerging market debt is interesting as well. Because it is true, the emerging markets do have a lot less debt on their balance sheets, whether it's consumers or governments. So that, you know, that's a definite positive that they have. And I do think they are going to continue to grow more rapidly than the so-called rich world. So
Right.
I think that, we're contrarians. We like to go where we think the puck is going to be, not where it's been. And I'm afraid that there's just way too many investors who are chasing the puck belatedly.
So you mentioned debt levels. How much farther do you think we can go in this country? We look better relative to Japan, say.
Right.
But that's not saying much.
No.
So at some point, I have to believe that this catches up. Where do you feel like we're at in the country's debt cycle, and what risks does that pose to your clients?
I think we're at the tail end. I think we've hit the debt wall. I really think when you look at a 300% or so debt to GDP, the ability to go higher, you can kind of reshuffle it. So for example, we've had some private sector deleveraging over the last 5 or 6 years, but at the same time, we've taken the federal debt from $9 trillion to $17 trillion, $8 trillion. I mean, it's pretty sobering to think about that it took our country basically 200 years to go from 0 to 9 trillion, and it's only taken us, 6 years to go from 9 to 17?
Right.
I mean, it's shocking. So really, there's kind of this myth that there's been deleveraging. There hasn't been deleveraging. It's just changed its composition or who's on the hook. But of course, in the long run, we're all, the taxpayers are on the hook for the federal debt as well.
Sure.
So it's, the expectation to continue to levitate financial markets through creating debt, which allows the pull forward of demand, and that demand could be in the form of buying bonds, buying stocks. I mean, that's really largely over. And I think you're starting to see that already because of its economic implications and the slowdown in the GDP growth rate in this country.
Right.
The GDP growth rate, it didn't start just 5 or 6 years ago. It started in 2000. So since 2000, the US GDP growth has been 1.8% per year, which is a little over half of what it had been for the 100 years prior to that. We're in a slower growth period. And unfortunately, given current policies, we don't see that changing. So it's kind of the PIMCO new normal. They took a lot of heat for that, but it's actually turned out to be fairly true. This more sluggish growth, or as John Malden would call it, muddle-through economy.
Muddle-through economy.
We're kind of stuck with that. And now, does that reconcile well with a stock market that's at one of the most expensive valuations ever?
Right.
We don't think so. I
And
think there is a disconnect.
The level of debt or quantitative easing required to move the needle just continues to grow. Your partner, Louis Gav, wrote about how the Fed had to expand its balance sheet by approximately $450,000 per job created post-2007.
That is an amazing
What
statistic.
kind of a logic, how do you justify that?
Yeah, it's very, very difficult to justify. It's, I mean, really, and you're seeing this, interestingly, with senior bank officials who leave the Fed are admitting that it really didn't work from the standpoint of Main Street in terms of getting the economy going, because as well as I do that typically when you have a very deep recession, including one caused by a financial crisis, you tend to have a very robust recovery.
Right.
We have had a very anemic recovery, far below average.
Right. If you don't measure recovery by the S&P,
right.
Everything else has certainly been anemic.
Right. So it really calls into question, because the QE was supposed to help Wall Street, which would then help Main Street. Well, it certainly helped Wall Street, but it hasn't helped Main Street. So I think you got to say that it's been a failure, and it's also been a failure from the standpoint of interest rates. One of the stated goals of QE 1, 2, and 3 was to lower interest rates. Right. Interest rates have actually gone higher, certainly since QE 2 and QE 3 were put in place. So it's, in many ways, I really do think when history looks back at this period, they're going to consider it to be a big disappointment. And we're going to see very different Fed policies in the future as a result of this failure.
So the incentives that were put in place by the Fed essentially rewarded financial engineering. It rewarded companies to buy back their stock or to borrow in the bond market and return money in the form of dividends to shareholders, which creates no jobs, doesn't improve their capital base or capital asset base. What needs to happen for that to change, and will it change? Well,
first of all, you're so right, because what's happened throughout this recovery is CapEx has fallen off a cliff. Mm-hmm. So companies are, a good fact there is the companies over the last few years have borrowed about $1.9 trillion, but they've only spent $500 billion, so about 1/4 of that on CapEx. So the rest of that has gone into, as you point out, financial engineering, share buybacks, mergers. What happens when these companies do big mergers? They cut jobs. They don't hire people. So there's a lot of negative unintended consequences of this long period of distorting the cost of capital. Because as brighter people than I have said, capitalism really doesn't work. It doesn't work well at all when you distort the cost of capital. It just throws things off, and we're seeing the ravages of that. So that, as you pointed out, that period of very low capital spending that's been going on for years, unfortunately what that means is you're going to have slower growth in the future.
Right.
And we've already had, as we just talked about, pretty slow growth since 2000.
So given all these risks, and there are many, but given all the risks that we've spoken about, how do you invest? How do you protect your clients' assets?
Well, I think one of the easiest ways to do that is to go where there's a lot of negative sentiment. There's just simply less risk when you have the consensus, the majority of the herd, whatever way you want to say it, are really down on something. And we talked about it earlier that right now there is such unanimity that you want to be in US stocks and you want to be out of bonds. And there's also, I think, a consensus view that when the Fed stops QE3, that's going to be disastrous for bonds because they've been buying so many bonds. But the reality is, as we discussed a moment ago, it hasn't lowered interest rates. And what it's really done is it's scared away a lot of the normal buyers of treasuries, particularly foreign governments like China, Japan. You know, they've just kind of said, well, you're doing that, we're going to go to the sidelines. But we do think that you're starting to see, actually a very good article in the Financial Times on this today, that pension funds, they're looking at this, I think, correctly. They're saying, hey, we've gotten a gift. We've had this huge appreciation in stocks. We can now sell stocks down, reinvest those at a higher yield because the 10-year Treasury right now is yielding a little under 3%. So, and of course, corporates are yielding more. And so I think they, mostly because they have to do it mechanically, are doing it rationally. We'd like to see more retail investors do the same thing. There's a lot of folks out there who aren't as young as they used to be. And they've, you know, let's say they're 60 years old and they've got 70% of their portfolio in equities. And they're moving into the retirement years. We feel like it's very important that those folks be reducing their equities and recycling that into conservative income securities. So for our clients, we're doing that. Now, are we getting criticized? Yes. You know, because by doing that toward the tail end of a bull market, by definition, you're going to lag.
Right.
But we think that that's crucially important. We think one of the biggest bad things that's happened with all the indexing and benchmarks is you become benchmark slaves. So there's I mean, if you really think about it, like in the late 90s, how could you have kept up with the benchmarks then? The only way you could have was to be heavily exposed to tech and telecom, which was exactly the wrong thing to do.
Sure.
Kind of the same thing today. If you're really going to be staying up, you've got to be heavily exposed to the stock market and typically to higher beta names. And
right.
that, you know, the problem is that, you know, you'll look good, you'll look good, you'll look good, and then you're going to look terrible. So you really have to be ahead of these things, and so that's what we're attempting to do. It's really a critical time, I think, for folks to be rebalancing. There's the old rule of 100, take your age away from 100, and that's what you should have in stocks. And like all rules of thumb, there's plenty of exceptions, but I think it's at least a good starting point. So I think anybody listening to this should, you know, kind of check their whole card and say, you know, am I too exposed to the U.S. stock market currently?
Okay. Well, and you just brought up retirement, so since you brought it up, I know you're an active guy and you look very fit, and I know you're incredibly involved in the day-to-day operations and investing at Evergreen. But what does the future hold for Evergreen? I
should say some clients are probably unhappy that I'm so involved and maybe think that I'm a little too conservative, but it's a great question. And we've been preparing for years for the fact that, you know, I am mortal and I'm now a grandfather times 4. So I do need to be thinking about that even more seriously. So we've developed this team approach, which has been in place for about a decade. So this isn't like something that's happened overnight. And frankly, we look at some of our competitors and wonder about, you know, what would happen if that key individual were to, you know, become disabled or pass away. So we've tried to be prepared for that in advance. We've also built processes like studying the mutual fund flows that help really systematize our contrarian approach. We also look at sentiment measures like in the futures market. So these are things that kind of happen regardless of who is, you know, at the controls. Admittedly, for right now, I'm the final decision maker, but because we've built a team of these younger individuals that now have got a number of years under their belt, if for some reason, you know, I wasn't able to come in, they'd be able to maintain the firm and maintain the philosophy.
To wrap this up, how would you sum up Evergreen Capital? What's your elevator speech?
Well, hopefully it's a slow elevator. I'll try to be as brief as I can. So Basically, we do try to recognize bubbles, which is, I think, unusual. And a few years ago, people were like, "Well, we're not going to have a bubble again, so that forget that one." Well, we're having a bubble again. So I think being able to protect your clients from those is hugely important. The other thing I would say that is unusual is our focus on cash flow, because we do. Many of our competitors are focused primarily on stocks, and if they get involved on the income side, it's kind of laddered bonds, and we take a much more complex approach to that. Than just laddering bonds. We'll use MLPs, for example, which over the last 20 years have been phenomenal total return vehicles for our clients. We'll look at things like emerging market debt. We'll even look at junk bonds when junk bonds are really inexpensive. Obviously, we have risk controls and we don't put too much in any one area, but I think that is really huge. Managing for cash flow, not just, well, we want a 50-50 portfolio. So I'd say those are, two of the most distinguishing, and kind of related to all that, the study of mutual fund flows, and really using that as a contrarian indicator, because we all know in the business that the typical retail mutual fund investor is the ultimate wrong way Corrigan, and we think there's tremendous information value in that. Look at what the herd is doing, and when they're doing it very intensely, you almost always want to go the other way. So,
good advice.
Like I said, I hope it's a slow elevator.
David, I always enjoy the time that I spend with you. I've enjoyed learning more about Evergreen Gavekal. Thank you very much.
Thank you, Ed.